Good morning, everybody. I'm glad you're all here with us today. Our topic today is with regard to the relationship between finance and accounting and development, and something that is often a challenging relationship, but an extremely important relationship. I realized that when I put the title on this, if fundraisers are from Venus and accountants are from Mars, it really does indicate how old I am, since that book was published in the 90s. I didn't quite realize it was that old, but for those of you who have no concept of what that book was about, have a look at it. For those who remember, I hope it's relevant as we're talking about this topic. The Phoenix Philanthropy Group produces webinars on approximately a bi-monthly basis, 6 or 7 a year. We also have an informative newsletter, as Amy has invited you to this webinar, Amy Mulhern, and as she shares with you a thank you and a survey after the webinar. Feel free to communicate through Amy at Mulhern at Phoenix Philanthropy with any questions or issues that you may have. And also this webinar will be rebroadcast, and she'll send you a link to that rebroadcast as well in case you want to share it with others on your team. But as this topic generated a lot of interest, so we've heard a lot of people who are not only joining us today, but will be following up with the webinar afterwards, because again, the issue between finance and accounting and development, when it goes wrong, it can be a real challenge in a number of different ways. In terms of performance measurement, there may be confusion. In terms of donor accountability and reporting, could be some confusion. So when there is synergy between the two organizations, between the two departments, then you can have common goals and mutual respect and enhanced performance measurement that is understandable throughout the organization. Accountability to donors is strengthened, and an understanding that key decision makers have when making decisions about the fundraising operation and the importance of philanthropy within the organization is enhanced. So those are the topics we're going to deal with today, and we've got two terrific friends and colleagues who are with us today. First is Colette Camps. Colette is the head of the nonprofit practice for Henry and Horn. She works exclusively in the not-for-profit sector, working on audits, reviews, and compilations, consulting, and tax returns. She's been in the industry for over 25 years. And in addition to those functional aspects that I described, she's very knowledgeable about industry best practices and operational issues in the not-for-profit world, which will come to benefit today in our conversation. And Sherry Mylott is the Vice President of University Advancement at the University of La Verne. She's been with that university since 2017 and has served a number of other higher education institutions in senior leadership positions. She has run 5 successful campaigns. Notably, when she was the Vice President of Development at Virginia Tech, it was a $373 million initiative. And at the University of La Verne, the campaign of $125 million exceeded its goal 1 year early during the height of COVID. So she knows how to raise money during times of adversity and opportunity. So we're going to start with Sherry. Sherry's going to give a little bit of an overview, as is Colette. I am too, as a former in the field fundraiser and vice president of advancement. We have plenty of time for questions at the end, but if you have a real pressing question that you want to ask, just raise your hand or put something in chat. Amy will be monitoring that. So Sherry, we want to hear from you now in your position as a Chief Advancement Officer, Chief Development Officer, Vice President of Advancement. What are some issues that you think are important in the relationship between your office, the advancement office, and finance and accounting, and give us a little bit of an overview of some challenges or successes that you've had and lessons learned in building those relationships.
Thank you, Richard. Good morning, everyone. I'm happy to be able to spend this time with you today because we all agree, or you would not be in this webinar, that these are critical relationships. We need to be mutually successful and talking the same language. It's not always easy. when you're talking with advancement and the financial end of the institution. It's critically important, in my opinion, that we, I said, speaking the same language, because we have to put out to the board of trustees, critically important, to the faculty and other internal audiences, that we're not in conflict. So even when we have difficult things to talk about, and I know we'll talk about some of those additionally today, we have to make sure we're in one voice, because the board and others get confused about how we're doing things and not coming together. The one thing that I'm always after with the finance division is to talk about return on investment. We'll talk about accounting and those sorts of things, but I always want to make sure the finance office and others understand it's not, from an advancement side of the house, just about the gifts you close. It's about coming together with the finance side of the institution to understand together we're approaching and achieving the mission of the institution. And the finance department needs to understand, just the same with the advancement committee and the board of trustees, that we're doing our work, and it's not always a yes that brings assets to the institution. To understand that we do a lot of work, we're going to get no's and those sorts of things. So the investment, they talk in investment language, and many times the investment into advancement, in my opinion, is part of my job with the finance division, because they need to understand what we're doing and why we're a smart investment. I feel really strongly that I need to be able to pick up the phone. So that relationship is so critical that I can pick up the phone and call the associate vice president or the CFO and say, this is where we are. Can we work together to make this happen? I need to put away any conflict we might have so we can solve donor issues and questions. So it's critical. And I think that this is a great conversation for us to have. Thank you, Richard.
And Colette, same question to you, but from your perspective as an accountant, as a CPA, as a member of many audit teams, how do you view the relationship, and what do you think are some key aspects?
Sure. Yeah. Thank you for having me here today. Good morning, everyone. I completely 100% agree with what Sherry noted. In my perspective, as Richard pointed out, is as an auditor. So I come in once a year, maybe a few times a year, and dig deep into the financial information. So just having that experience over 25 years of doing that has provided me with, I think, the experience of seeing some of those issues between the two departments. I know we see that a lot, and because I work only with nonprofit organizations, I can kind of compare one nonprofit organization to another, and it is a common problem. From an accounting perspective and from that experience, I think obviously the most important thing about that relationship, which Sherry mentioned too, is just communication, and just the level of communication between the two departments. It's so important from a financial reporting side, just to make sure that the financial reporting is accurate. And again, this is an accounting perspective, of course. I think the challenges are mostly just related to having effective communication, which is really dependent on an understanding and knowledge. Sherry mentioned that the accounting side needs to understand what the development side, the advancement side, is trying to do. What are their goals? What are they trying to accomplish? And it goes both ways, right? The accounting side also needs to communicate to the development side what they're trying to accomplish and why it's important.
Right.
I think if the accounting side can explain the why behind the requests for certain information, or for certain information to be provided a certain way, if that can be explained clearly and when it's needed, then I think there can be a lot more success in that relationship. I think if one side is being asked for certain information, is being asked to spend time to put certain information together or to implement certain processes, but they don't understand the why, they're going to be less motivated or less likely to want to comply with those requests. So I think that's really the key, is just understanding the why. An example of what I've seen where this can work effectively is I've seen across several of my clients where the accounting department and the development department have worked together to create either weekly or monthly cash flow projections. And I think that works well because both departments really understand why that's important and both have the information to help put that sort of information together. As far as helping the board or the finance committee or management review that financial information to be able to help them with their fiduciary responsibilities and in decision making. I have seen, as far as challenges, I have sometimes seen a little bit of the us against them mentality between the two departments, which can definitely be detrimental to the overall culture of the organization. I really do think that feeling will come mostly from a lack of the understanding of the why behind things, because it is just frustrating for people to not understand that, but to still be required or be asked to spend extra time doing something. So I don't think development people need to become accountants or understand everything that accountants know. Obviously, that would be unrealistic, but just having at least an overall awareness and understanding and that communication, I think, can just help ensure from the financial reporting side that everything is recorded accurately.
Great. Sherry, any comments to that?
No, I agree completely. And the coming together, the numbers, even on a monthly basis, is so important, Colette, to what we're reporting together to our governing boards and others. That's always not a monthly challenge, but it's always a monthly conversation.
So I'm going to talk a little bit from my experience, both as a vice president of advancement and as a consultant who works with a lot of different clients who really need to and have the opportunity to enhance this synergy between the two departments. As when I was a vice president of advancement, frankly, there were a number of challenges between development and finance and accounting. I learned why it's important to be cooperative the hard way, unfortunately. And you know, there was just kind of a constant sense of conflict where how do we report our numbers? How do we report total production? There was a tendency only to pay attention to unrestricted money, and particularly unrestricted cash, as opposed to temporarily or permanently restricted resources. When we talk about production, we wanted to talk about, and we do talk about in case standards say to talk about total production in terms of total commitments, being cash, multi-year pledges, and planned gifts. And then the difference between recognition value and the accounting value or cash equivalent value of those gifts. In the case of sophisticated planned gifts, we had some very sophisticated donors who were in the finance industry. So they were able to put together very creative gifts, which frankly helped them to optimize their level of giving. And we got pushback from the finance and accounting side that they basically were just trying to work the system, that they were trying to, you know, take advantage of the institution instead of giving outright cash. And it really had to do with the management of their investment portfolio overall and taking into consideration things that we knew that maybe weren't that relevant to finance and accounting, such as their kids, you know, their spouse, thinking about other people and how to optimize their legacy with their family as well as the nonprofit institution that we are serving. The cost of raising funds is always something that is an issue. What Sherry said, and I will come back and ask a question about this later, but the ROI is not just about the gifts close, it's about the mission, which I think is really important. But even as it relates to gift close, what does count? Is it that total commitments, that total production, or is it unrestricted cash? Fundraising participation rates, we had challenges with that. And in our case, we had to report to an accreditation institution on a regular basis about our alumni participation. And how do you count the number of alumni who exist? Are they the alumni who are reachable? Are they alumni who are only alive? the way they wanted to count it was anybody who had ever, exited that institution alive or dead, whether or not we could reach them. And that obviously puts your numbers completely out of whack. Looking at the data and information management systems and what's important in the database and how do you manage a database in a way that allows the development folks to look at it in terms of a CRM, but then you align with finance and accounting on the financial aspect of it, really important. The timing of donor gifts, it's we don't have control. If somebody wants to give a gift December 31st or January 1, June 30, or July 1, that substantially impacts our numbers, but we don't really have control of that. And then, unfortunately, the biggest challenge that we had in this situation was in terms of the use of donor gifts. And in the case that I was in at the time, their restricted funds were being used to plug holes in the budget and weren't being used in a way that was in which the donor designated the funds. So again, a worst case scenario, which I'm sure none of you will ever have to deal with, but I had to become a whistleblower in terms of the misappropriation of funds. But the opportunities that we had in this situation were also significant. We learned the operational efficiencies that come from a good finance department and a good operations department. So we definitely weren't operating as efficiently as we could. And when we opened our eyes and ears to their recommendations about how to manage our department in a more efficient and effective way, that really helped a lot. And then we developed what we call the donor accountability group. And many of you probably have a gift acceptance committee that looks at the gift standards that you have and the accounting standards or counting standards. We took it a bit beyond that because we wanted to be able to not only talk about receiving a gift and how we were going to place a value on it, we wanted to be able to immediately report back to our donors how their funds had been expended. We had a donor, very sophisticated. He would literally call us, or his finance and accounting people, or others in his company would call us and say, what happened with this money for that scholarship or that professorship or this institute? And we had to be able to report it immediately. So we put together a donor accountability group that included the finance and accounting folks, the development folks, as well as those parts of the institution that were most responsible for spending the money and managing it. Student affairs, academic affairs, the library. All of your organizations have comparable programmatic departments that could come to play in that type of donor accountability group. And it allows us to be ever more effective in working with our donor relationships. And then a couple of things as a consultant that we've learned is, as Sherry and Colette have talked about, the issue of proactive communications and engagement is really important. And I do really mean proactive. Get in front of each other early on so you can anticipate where there might be problems and cut it off at the pass, as opposed to coming to a board of trustees meeting or getting in front of the CEO presenting, documentations and performance reports that aren't aligned. So working that all ahead of time, understanding kind of your standard suite of performance reports, and knowing that in many cases there's going to be some misalignment of numbers, but how do you track the numbers back to one another? How do you show, while I'm showing campaign or recognition value, you're showing, the gap and FASB numbers, how do they align and how can that be important? And I talked a little bit about donor accountability and service is important. And then two other areas that I think are important for kind of this proactive stance. And one we learned with the University of Laverne early on in the campaign. One of the big initiatives in the campaign, and this was before Sherry was there, one of the big initiatives in the campaign was a STEM building, a science building. That was top of the list of the strategic plan and the master plan, but frankly, the donors weren't interested in funding it. And this, again, probably 7, 8 years ago, they weren't interested in funding it, but they, the university needed to understand how they could afford this building. So what we did on a regular basis is sit down with the CFO and talk about, okay, here are our priorities. Here's how much we're raising and project we're raising. If we don't fill up that bucket for that building, but we fill up these other buckets, and these are budget relieving funds, they can impact the bottom line, and funds become fungible that you can take institutional money, invest in the building. We needed to stay on top of that, frankly, on probably a monthly or quarterly basis, because it impacted, if the institution was going to look for debt or bond financing, whether they were going to look for social impact investing, whether they were going to have to allocate institutional funds. So that financial scenario and that play was really important. And then donors want to know how their investments are going to be sustained long-term. And so that issue of financial sustainability and health is something that's very important as well. So being able to proactively discuss and have the scenario in play with finance and accounting about how this center or institute or program is going to generate revenue in the future, how it's going to be sustainable through a number of different ways, how it's not going to always be dependent on the contributions, certainly of that donor, but even philanthropy overall. So being able to do those scenario plays, I think is really important. So that's some introductory remarks and kind of our position on the topic. And I want to now jump into a couple of questions, starting with Sherry. And this is about true performance reporting. And you've touched on it a bit, and I would like you to talk a little bit more about the mission orientation to things. But, as we're reporting to the president and the CEO or to the board of directors or trustees, it's more than just unrestricted cash. But we know cash is king, and and the board and the CEO and others want to know how much money they're going to have to spend over a period of time. So how do you have that conversation both about true performance and the resources that you are raising for the institution short and long term vis-a-vis unrestricted cash that's more immediately available to spend?
Thank you for that question. But before I go there, the donor accountability group, I've learned something already from this conversation. I'm taking that and running with it. It sounds perfectly appropriate for our university. The cash is king clearly plays a role in our work with the finance office. When you're particularly if you're in a budget tightening time, and the board and the president and the finance office are looking at you, help us relieve our budget. Those are the most difficult funds to raise. And we have to be in lockstep as much as possible with the finance department to say, don't go to the board of trustees and say, the advancement office needs to bring in more operational money to offset the budget. Because that looks badly at advancement. They all turn to me and say, why can't you bring in more unrestricted money? It's important. We all know it's important. And our institution currently, $55 million of our budget supports student scholarships. So everything we bring in, even scholarship monies, help the bottom line. But that board of trustees, the advancement committee, I sit in on the finance committee as well, which is critical in communications, and the audit committee. I sit in on those meetings and I invite them to sit in on our advancement committee meetings. But when they turn to me and say, what are you doing? My job is to communicate it and make sure the finance department understands too, that we're doing things that are long-term investments in the institution beyond this year's needs. That is, Richard referred to, and I said earlier, we have to come together and have the common goal of moving the mission and supporting our students first and foremost. So all the things that are happening in the background shouldn't get to the governing board. Sometimes it does, and that's when hackles go up. I'm sitting there thinking, but we just closed a $10 million gift that's going to do this for our students. But yes, it's not offsetting the budget. There is The only way around that, and it still happens in the institutions that I've served, you try to have that, and you walk in there and you get put on the spot like this. The only thing that can happen is having that relationship going into it, and I haven't always been successful.
I think the issue of filling the gap is something that, particularly when you are a smaller nonprofit organization where contributed revenue is going to impact your ability to pay staff or to mount programs. I mean, I started my career in a couple of different organizations where that was the case. And if we didn't bring in cash, people didn't get paid on time. Programs were delayed. And that's really tough. But again, as you are looking at real production and the idea that multi-year pledges are going to have value, not all in year one, but over a 3 to 5 year period. The cash flow of a planned gift may be 15 to 20 years, but what's that do for kind of horizon planning? It does allow you to have an understanding of cash flow in a longer term.
May I give one example, Richard, of what you're saying? I worked early in my career at a very small liberal arts college in the Northeast. It was expected to be an experiment. If it doesn't work, we're closing the institution. It never works that way. Every single year, we've raised about $35 million a year if we were fortunate. But every July 1st, I started with a $10 million unrestricted goal to do just that, to balance the budget. That pressure is immense. Everyone's looking at you. How are you going to bring in 10 million unrestricted gifts? And we were always, as much as we wanted to be in front of this, we were always patching it together. So by June 30th, we were paying all the salaries and doing those things. It was a huge bogey to reach.
So Colette, any feedback on this issue?
In hearing you talk from the development side, the advancement side, it sounds to me like you often probably experience rigidity in the accounting department, more of a black and white approach.
That's a good word to call it, rigidity.
and a black and white approach is unfortunately sometimes how accounting teams think. And they do kind of think within their own box, not, the greater, for the greater long-term goals of the organization, as you're pointing out. So I think, again, that reaching that ability to maybe encourage some more flexibility in that thinking is all really going to come down to the communication and having the relationship. You can't just be emailing each other information all the time. There has to be these meetings and this relationship developed in order for that to improve.
Building on it, and Colette, you were talking about organizations that look at weekly or monthly cash flow projections. And when we were preparing for this, I talked a little bit about our client, the Arizona Science Center. And a number of years ago, the CEO and the CFO, who were both brilliant business people, wanted the development department to be able to present revised projections on a weekly basis.
Mm-hmm.
And as their consultant, I told them that's ridiculous. We can't possibly do it on a weekly basis. And you don't control the timing of your donors' gifts, as I said before. Or, they may give cash, we may convert assets, it may be, partially, it may be a blended gift. All these different scenarios that could come into play, which made it impossible for us to do projections. Well, they kind of patted me on the head and said, we don't care what you think. We're going to do this on a weekly basis. And it was terrific because the way that the CFO and the VP of advancement and our team worked together, we were able to break down their prospect tracking list in a way that we were really careful about timing gifts. We were able to look at target ask amounts in a more strategic way. And so, frankly, what came out of it is a real refinement and honing of development's processes about relationship management, moves management, and all of that. Now, we had a couple of caveats out there. Again, if somebody gives a gift December 31st versus January 1, you wanted to know that the work toward securing and finalizing that gift was in play. The numbers may not show that, but you need to show activity reports as well. But I have to tell you, it really worked out. It made the organization just much better overall in terms of its financial management, and it helped to really hone the skills of the development team as well.
Well, and I would think just that almost forcing that weekly projection and committing to making it work requires those two teams to work together. So they're going to have to be constantly working together if they're doing that on a weekly basis, which is just better overall too.
Yeah. Okay, Colette, we hear about FASB, the Financial Accounting Standards Board, and GAAP, the Generally Accepted Accounting Principles. So tell us what those are. Tell us how it impacts this discussion, and how the development folks need to think about those and understand those terms and how they impact the numbers.
Sure. Yeah. Hopefully this won't bore everybody, but going back to what I mentioned earlier, what we've been talking about, just having, and I think if development does have a better understanding of the why behind the way the accounting team does do things or what they require, that why is so important. So hopefully I can give you kind of just like a baseline of where the accounting team is coming from. So to start off with, development people may not know what the accountant means when referring to GAAP. So GAAP stands for Generally Accepted Accounting Principles. These are principles that are actually written and required by a national board called the Financial Accounting Standards Board, also known as FASB. So you may have heard that term before. The FASB issues accounting standards that explain all the requirements for how certain types of transactions are supposed to be accounted for. They also provide information about or requirements about what information is required to be included in footnotes and disclosures in the audited financial statements. If you've seen the audited financial statements, you're familiar with the disclosures. Those are all requirements based on the FASB's rules. So these FASB standards can get very technical. Sometimes they can get very complex. Some of them are specifically related to nonprofit organizations for items such as contributions or split interest agreements like charitable remainder trusts. And then other standards that they put out are required for all entities, including nonprofit organizations. So when a nonprofit organization issues audited financial statements, which is at the most on an annual basis, you're required to issue those financial statements to be in compliance with GAAP, which includes all of these various accounting standards. So when your auditors come in to audit your financial statements on an annual basis, the auditors are focusing on that. They're ensuring that the transactions are recorded in accordance with GAAP. So it is to some degree pretty black and white, like I mentioned earlier, but there is a lot of room for flexibility. There are a lot of times when judgment is involved. But once the auditors review various different types of transactions that occurred during the year and then eventually issue the audited financial statements, in that process, the auditors are required to follow other standards, which are put out by the American Institute of CPAs, the auditing standards. So there are a lot of rules, a lot of requirements, which I think is why accountants do tend to be a little bit more rigid in their approach to things. An auditor will check that the organization has applied all those standards correctly, that the financial statements are prepared in accordance with GAAP. That's what the auditors give their opinion on, so they have to ensure that. If there's something found, so through the audit process, an auditor might find that something was recorded incorrectly. If they find that, and if that dollar amount is significant enough, the auditors would be required to write up the organization for a finding. In auditing terms, that would be a significant deficiency or material weakness, which you may have heard those terms. So if the auditor does determine that the organization has one of those types of findings, they are required to put it in writing in a management letter Or if there's a single audit where you're receiving federal funds, that finding becomes public information as single audits are submitted to an online clearinghouse. So, really what that means is you want to ensure that your financial transactions are recorded correctly and in the correct time period to basically avoid those findings, because a lot of times those management letters are required to be, grantors a lot of times will require a copy of the management letter before they will provide a grant. Even though the management letter is meant for management of the organization, it's not always confined just to management. So that's kind of an overall description of where your accountant's mind might be, especially if there's an audit of the financial statements at the end of the year, just to ensure everything is accurate, recorded properly.
And that the fact that it's public information, that the agencies like Charity Navigator and others take those into consideration, and that your funders will require audited financial statements before making grants, gifts, or grants, make it even more important.
Right, exactly. Yeah, so that's why, of course, the accountants are trying to ensure that everything is reported correctly to avoid that situation.
We had a webinar recently about how to tell your performance stories in your 990s, and that there are opportunities in various aspects of 990s to include a narrative or other things like that. Is there an opportunity to do that in an audit?
Well, the audited financial statements really belong to the organization, to the nonprofit organization. There's only one part of your audited financial statements that belongs to the actual audit firm, and that's the opinion or the auditor's report, which is right at the front, a couple pages long. So yes, you are, to answer your question, yes, you are allowed to include any information you would like in your audited financial statements. They usually start with a paragraph describing the nature of the operations of the organization, which is usually quite brief, but the organization has the ability to expand on that and describe anything they'd like to in that footnote.
Great, that's helpful. Sherry, the fundraising side of the house is generally guided by case standards. So talk a little bit about how you look at case standards, define it for people who may not know what it is, but how do you use that? And to the degree that you can discuss this, the alignment between case standards and FASB and GAAP.
So CASE is the Council for the Advancement and Support of Education, and they do have guidelines. It's not the same as FASB. You don't get audited on those guidelines. It's what they suggest for best practices for how do you count from the advancement side of the institution. We follow those things as technical as don't count government grants and those sorts of things come in for faculty research. If it's coming from government, don't count it in your campaign. I've been in a place that did count it. Again, there's standards. You're not audited on those standards. There can be gray areas and where you find them. I don't advocate for using gray areas, but to Colette's point, sometimes advancement works in the gray more than her side of the institution. That's where the communication can fall apart. So we have standards, you have FASB. I want to talk in grays. They want to be in black and white most of the time, not comfortable in the gray, vice versa. I don't always like the black and white, but the standards help guide us to where we ought to be trying to talk the same language. One of the standards is in how you count pledges. I find that to be one of the most challenging conversations to have with the finance side of the institution. So for example, we're building, and Richard, to your point, that academic building you're referring to, it has morphed into a college of health and community well-being. We've gone back to those centers and say, wouldn't you like to think about moving your support from an academic building that's not going to happen into another part of the institution? Good, successful conversations. But pledges, particularly in capital projects, they're difficult. Those are difficult conversations. I might have someone that's making a pledge payment over 5 years. But the institution needs that money to build that building next year. So how do we bridge that gap? I know I'm reporting pledges through the case standards, 5 years. I can put them I can count them from the advancement side of the institution. Well, what does that mean for cash in? What does that mean for projects that have to be paid for now and the pledges are coming in later? Those are some of the places where how you count things in FASB, how we count things from advancement, that can be a difference, requires good conversations. And again, from just a pledge piece of case, what does it mean for cash flow of the institution? That's a conversation.
Great. We'll open it up for questions in just a second. I'll ask one more. So if you have questions, raise your hand or submit them on chat. With regard to pledges, since we've both talked about that a little bit, what is your opinion about whether or not pledges are legally enforceable, and the need or lack thereof of reporting and taking into account the potential write-off of pledges? So whoever wants to start.
May I start with the write-off of pledges?
Sure.
That is one place that we do have conflict. Sometimes, no, actually, it's not conflict, conversations, not conflict. I, in one institution, had a board chair who made a very generous pledge. Life circumstances changed. He wasn't making the pledge payments in the time that we expected. Finance office comes and says, we've got to write some of this off. I'm like, how can I have that conversation with that donor that he's not making his pledge payments and he's going to see where all this is happening? How do I handle that communication? And fortunately, in that way, the finance office and advancement work together about how could we, by standards, write off the pledge, but not go deeper than we had to in writing off that pledge. It's a difficult donor conversation.
So one way accountants can be flexible, and I think it's so important for accountants to be flexible when working with development on issues just like that, Sherry, is in a situation like that, just to use that specific example, is that the organization can record an allowance. So if the pledge is for $1 million and they haven't been making their pledge payments, you don't have to write it off necessarily on the accounting records. You could record an allowance for the full $1 million, which then is a conservative approach from a financial reporting side, where you're really reporting zero for that asset on your balance sheet, but yet it's still there. It's still, and then if it's collected later, you just adjust your allowance later to reflect that. And then also, I think accountants have to rely on and trust the development people as far as their relationships with these donors. And development people are going to have the sense for whether these pledge payments are going to pick back up again or not, just from your relationship with that donor, your conversations with the donor. So accounting needs to rely on that and not think so black and white. And if they, really need to be conservative and record an allowance, then that's one solution. I think timing of promises to give is, I think, probably the biggest complaint, and it's the board of directors hates that rule where you record it in full as long as it's promised. When it's promised and the period is promised, even if it's a multi-year promise to give, you have to record that income in the time period or in the annual reporting period that it's promised. One way you can be a little bit creative is to understand the difference between a promise to give versus an intention to give. So accounting standards define the differences between those two. If you have a promise, you're required, and it's unconditional, no conditions have to be overcome, you're required to record that income in full upfront. If it's just an intention to give, you're not allowed to report it until the cash is received. So if you really want to only recognize the income in the time period the cash is received, that might be one way to structure it. It does mean, of course, that it's not a promise, so it's not legally enforceable. So the donor may have an easier way out of making future payments because they haven't made a promise. So that is kind of the risk side of taking that approach. But it is a possible solution, to if you are trying to recognize income in the period you're actually receiving it. I think another question I get frequently from my clients is, how do we present financial information to the board of directors or to the finance committee on a GAAP basis, but still they want to see that, you know, this cash is coming in, even though we recognize it as income in a prior year. One possible solution to that is to, and I think every organization is going to be different as far as what makes sense and what the board needs to see or what the finance committee needs to see. But one possible solution is to set up your financial statement that you provide to the board the way it's set up in the audited financial statements, which means your income statement has a column for unrestricted, a column for restricted, and a column for total. And so that way you can clearly see what has moved from restricted to unrestricted, what has come in that's restricted, that's new, but it's restricted. So it's in that running total of what hasn't been released from restriction yet. It might be a clearer way for everyone to review that information and communicate about it. Another option I've seen clients use is to include a reconciliation, like Richard mentioned earlier, some sort of reconciliation as simple as possible at the bottom of your income statement. And also to remember that like a budget to actual financial statement that is reviewed monthly by management, by the finance committee, by the board, doesn't have to necessarily be 100% in compliance with GAAP. It's really just your audited financial statements at the end of the year that have to be. So I think it's okay to adjust. Maybe you report on a cash basis every month, or maybe you just don't worry about the discount on promises to give until the end of the year. You know, whatever adjustments you can make that make that process easier to reconcile between the two. You have that flexibility. I think the only thing that's important there is that you are ensuring that you're communicating any differences from GAAP to whoever is reviewing that information. And as long as they're fine with that, which I think in most cases they would be, you want to provide them with the information that helps best with making those financial decisions.
So I learned something new about the difference between promise to give and intent to give. Mm-hmm. So what's your recommendation with regard to, you said that there's risk on the intent side. What is your recommendation to nonprofits then in how they put together their pledge agreements or their intent agreements? How buttoned down should those be?
Yeah, so if you wanted to go that route, and again, there is that risk, but if you wanted to ensure that the donor was providing an intention to give, I think it requires communication with the donor so that they understand the difference. As far as the actual written agreement, it would say something like that it's an intention to give, that it's not a guarantee, that it may depend on their future financial conditions, something of that nature, that shows that it isn't a promise. So it does, like I said, it has some risk because it does give them an out, but if you're willing to accept that risk in order to recognize the income in the period it actually comes in, you know, it's kind of a balance.
Wow. Go ahead, Sherry.
I'm hearing what Colette's saying and the question Richard asked. In my opinion, nothing's ever sure. So whether it's an intent or a promise, I can have an ironclad gift agreement, what it's going to be for, how it's going to be paid can be out there. If the donor doesn't do it, I'm not going to enforce that gift agreement. We walk away from it. If they say, I don't want to do this more for whatever reason, I'm not going to go after the donor to say, you owe us this money. So in some ways that there's a give and take there too. You're just not going to go, I would never go after it and say, you said, and you're not.
Right.
Yep.
Right.
And technically a promise to give is legally enforceable, but you're right, Sherry. I've never seen any client, even if they've been very irritated about a donor not making good on a promise to give or a pledge. I've never seen anyone legally go after. It's just not good for the reputation of the organization.
Right.
All right. We don't have any questions in the chat. Anybody want to raise their hand or feel free to speak up if you've got some questions? No question.
Hi, this is Bonnie Baker from Northern Arizona University.
Hi there.
Hi. We have questions about donor advised funds, and this relates a little bit to that intent to give. versus a pledge. You know, we've been following guidance that says we can't record these as pledges.
Right.
Is there any new guidance or insight into how you handle donors who want to pay their pledges with their DAFs?
So when a donor puts money into a donor advised fund, they are, and where they can give advice on how that money is spent, they're making a contribution to that fund. So the advice that they're giving doesn't mean they're making a contribution to the nonprofit organization, which is why the nonprofit organization can't record it. Because in order for that to be tax deductible for the donor advised fund actually has the ultimate authority or responsibility to determine where the money goes. So they could potentially decide to not give it to the organization that the donor advised to give it to. I think that rarely happens, but they do have that responsibility or authority to do that. So that's no change in that as far as I'm aware.
If a donor is making a pledge and they may make a annual payment from their DAF, just as they may from their checking account, just as they may transfer stock, whatever it may be, can you still not count that DAF component? Or should you just work with your donor to say, don't tell me how you're going to make these payments? This is great. This is a gray area that, as Sherry was talking about, that maybe is too gray. But, you know, bottom line, if it's their intent to pay for it from a DAF, in my mind, they shouldn't tell me that. You know, they should just tell me that they are going to fulfill their pledge. And if it happens to be made out of their checkbook, conversion of assets, DAF, I don't care, so long as it comes in.
Yeah, I think once the donor makes a pledge or makes a promise to give and it's unconditional, it's required to be recorded. If you feel certain that it's going to be collected, or you have some degree of certainty, obviously you can't be 100% certain, you're required to record it. So as far as how they plan to pay it, really shouldn't affect that. So if they pay it out of their DAF, then they have to pay it from somewhere else.
Okay.
I'm sorry. The other thing is that how do you write down that pledge as a payment when it's coming in through a DAF? And we do it, I'm not sure how it meets standards, but we do it as kind of a soft credit. That's been paid. It's not a direct payment. We write down that pledge payment's been made as a soft credit.
Great. Anybody else have questions? Okay, hearing none. We've got about 5 minutes left. So Sherry, why don't you kind of give us your lessons learned or advice and counsel on this topic as we close up for today?
One thing I wanted to share that you want to avoid, and it can happen even in the best relationships, when you're depending on how much your fundraising supplies your budget, fills your budget up. For us in a tuition-driven institution, unrestricted fundraising is a very small percentage of the incoming revenue that can be counted towards the budget. So tuition might be 95% what's coming in. Fundraising might be a very small percentage. Even if you're raising $30 million a year, that unrestricted part could be very small. And in another institution where relationships aren't working, the CFO was in front of the board saying they're not doing their job. They're only bringing in 1% of our revenue. That's a nightmare. And when a CFO is pushed hard on that in front of a board, that can happen. And that's where I really want to go back to, let's represent each other equally and well and have respect for what each of us is doing for the institution.
Great. Colette?
Yeah, just to pull it all together and to reiterate what I said earlier, I do think the two most important things are effective and frequent communication and awareness of the why behind everything. And so I think if development does not feel that accounting is explaining the why, they need to ask, and accounting needs to explain, and it goes vice versa too. I think it's really beneficial when there is a regular standing meeting between, for example, the development director and the controller or the CFO, or maybe both teams together, where there's a set standing agenda and you include certain items that you need to communicate about, or you need to communicate about, like the pledges receivable schedule, collectability issues, any new restricted contributions that might be coming in and what those restrictions are, or maybe they're just expected to be coming in, the status of grants applied for and reviewing grant agreements together. If the development department has been notified of any bequests coming in, or that they've been named as the beneficiary in a remainder trust or any sort of split interest agreement, any other types of unusual gifts that might just be on the horizon. And also just to discuss what processes are currently in place as far as ensuring that communication happens. That can be discussed at these regular meetings as well. And also discussing just any improvements or changes that might need to be made to those processes. So I just think these two teams really, like we've said throughout this whole hour, these two teams really need to work together especially when there are significant contributions, and especially when there are various different types of contributions. So this communication is just really essential, and the relationship is so essential.
Well, that standard meeting with a standard agenda is a great idea. And what Sherry also said about invite the finance and accounting people to the development committee and vice versa. Be on the finance committee, be on the audit committee. I think that, in addition to the chief development officer and the chief financial officer having a strong relationship, building it into those committees and throughout the staff is really important. So, well, and the only thing that I would add, which is just building upon what they both said, is proactivity. Get out there in front of any of these issues as quickly as you can, because you, as Sherry said, you don't want to get before the board of trustees or the CEO or the executive leadership team and have anything at question or have anything where you're not agreeing on something. So that proactivity, I think, is critically important. So thanks everybody for being here. Thanks Sherry and Colette. That was terrific. I learned a lot, so I hope everybody did. Our next webinar will be in about 6 weeks. We're doing it in partnership with the Aspen Leadership Group with regard to first-time chief development officers. And so if somebody has come up through the ranks as a major gift officer or advancement services or annual fund, all of a sudden they're a chief development officer, what are some of the lessons that they need to learn really quickly in taking on that new and more expansive role? So again, thanks everybody.